Good evening, everyone. This is Wayne, and this is the video version of the trade report for Wednesday, March 21st, 2018, otherwise known as Fed Day. Well, the Fed raised interest rates a quarter point, and that was what was expected, but there were a few things that weren't expected, and the markets reacted. Stay tuned to find out more. Good afternoon and good evening, everyone. Thank you very much for spending part of your day with me as we go over the events of the day in the stock market, a market recap of sorts. Well, as always, I like to start with the S&P futures, which is the 15-minute chart that we have in front of us. That is the chart that I refer to as we make our way through the trading day. And from the extended session, or the overnight session as we call it, which is in this grayed out area here, this grayed out area, and then as it reaches the white area, which is the open of the US regular session, and then moves again into an overnight / extended session, which is where we are now. You can see that overnight things were relatively subdued. We rolled up and down and all around and opened the day a little bit lower with a little bit of a move to the downside, and then we started moving up and another move to the downside, another move up, a little bit of a move down. It looked like we might just kind of bob around like a bobber in the water on a lake trying to catch a fish, but then seemingly out of nowhere we got bought. We started getting bought, and the market definitely went higher, and of course then it started going lower. And as we became, or as we came closer and closer to the Fed time, which is 11 o'clock a.m. Pacific time, 2 p.m. Eastern time, the market started to get all excited. They started going higher. And so when the markets, or excuse me, when the Fed did announce at 11 a.m., it was a big pop to the upside, then a big retracement to the downside, and then a move back up. And that's just all in keeping with usually what happens when the Fed announces. So as you can see, subsequent to this candle, which was the 11 o'clock to 11:15 candle, we had a lot of price action and a lot of downside action. And then we had a little bit of a recovery and then more downside action into the close with just a skosh of a recovery. So all of this is in keeping with what typically does happen on Fed Day. We never know if the markets are going to go higher, lower, or both, but we never know how they're going to close. It's really all about the interpretation that the markets give the Fed announcement and the testimony that the Fed chair gives subsequent to the Fed announcement, which is usually in the form of a press meeting. So today it was a press meeting. Periodically, it's actually congressional testimony where they speak in front of Congress and answer questions from the House. So today was a little lower key, but oftentimes the press can also be pretty pointed as well. But as Chair Powell was answering questions, the markets were taking a dip to the downside, and then they moved back up again, and then they started moving down again. And the bottom line here is the takeaway from today was, first of all, no surprise that the Fed raised interest rates a quarter point. That was expected almost 100%. However, their forecast for the upcoming raising of interest rates, specifically for year 2019, was raised. So there will be more interest rate hikes in 2019 than originally expected. That took the market a little bit by surprise, but because it's so far in the future, there's a little bit of a mitigation factor that occurs. It's kind of a smoothing. It's like, oh, okay, well that's a long way away. We don't really have to worry about that now. The market is reactive. It's more it's more acute in its reacting than it is chronic, unless there's something that is extremely prevalent on a geopolitical basis, like a financial crisis or a financial meltdown, for instance. So obviously, back in 2008, that encompassed the entire financial system and economies of all the countries in the world, and so we had a perpetual down move that, well, we all know how that ended. But for something like the raising of interest rates, which does put pressure on corporate profits, and corporate profits are the, as it has been said, and I'm just repeating this, the mother's milk of a bull market is the corporate profits being as as expected, or or beating estimates from the analysts that cover the companies that report earnings, the public companies that trade on the stock exchanges. So today's action was definitely raucous. We had back and forth. The volatility went up and down and all around. And although in the great scheme of things, this was really more of a dog and pony show. This was what was expected. The price action was expected. The reasons why we got the price action was a little bit of a surprise. But in the great scheme of things, this really was relatively contained. So I'm not really looking at today's action and drawing any conclusions per se from it, even though we did close the day lower. The Dow Industrials closed down almost 45 points. The S&P closed down 5 points. The NASDAQ closed down 19 points. And the Russell, that wily Russell, actually closed up today. It closed up almost 9 points. As you recall, all the indexes closed up yesterday, but the Russell closed down. Well, just the opposite today. The S&P, the Dow, and the NASDAQ closed lower. The Russell closed higher. So, and in fact, if we can just take a real quick look, this is the Russell down here. And you can see how it kind of went up from the beginning of the day, went a little bit sideways to lower, then up, then down, then up, and then down. But all the other indexes kind of collapsed into the close. So, we have a market that is not really trading in unison. So there's some disparity here. Now, will tomorrow bring some clarity? Well, that's always a good question, and one that needs to be asked virtually every day. And of course, we observe the markets as they trade on a daily basis to determine what it is they're trying to tell us. And today, there was basically more questions than answers that ended the day. So we need some more clarity tomorrow. We have a market that looks like it could actually go to the downside further tomorrow. There was really not a lot of energy that would have led me, at least, to believe that this market has the desire to go higher. There was this push here that kind of ended up collapsing into the close. And this up move, I don't want to say that it was a fake out, but at the same time, it couldn't get any traction. There wasn't any real ability for the market to convince market participants that it was time to buy the market. So what they did is, well, they did what the other alternative is, and that is to sell the market. So as the market sold and sold some more, the other indexes, of course, followed, and we had some individual issues that also participated in the sell-off. Now, one of the most egregious examples of the selling today was Apple, and for the life of me, I cannot find a reason why Apple sold off as much as it did today. I mean, it really pulled back hard. And from its all-time high, which was back on March 13th, its high was 183.50, and today it closed on its low of 171.26. Actually, it closed 171.27, so a penny off its low. But I mean, almost $11. That constitutes approximately 7%. So we're not in bear market territory yet, but Apple's really taken taken a beating here. And again, I don't know why, but I will tell you that as I look at a chart, I'm always looking at all of the indicators that I have in the chart. And in this particular case, we have the Ichimoku cloud, which is showing this configuration, which is known as a pool. And the pool will basically be an attractant for price. And if it's a red pool and price is above the pool, the red pool is a bearish aspect of the Ichimoku cloud. So if price is above the Ichimoku cloud, especially with a pool configuration, we have a downside attractant for price. So that is a strictly technical perspective based on the Ichimoku cloud indicator. So, take that with a grain of salt or two. But like I said, for the life of me, I looked at news. I looked at everything I could find to try to find a reason why Apple would be sold, and there really wasn't one. So I am providing you with a technical reason, but regardless, the market has provided us with the truth of what's going on with Apple, and it is getting sold. So it's in a quite a sell-off actually. So the next stock that we need to look at is Amazon. Well, Amazon actually got sold today as well. Now, all the markets, traded a little bit lower today, as I mentioned. There were a few issues that ended up on the day, but for the most part, we did end up trading lower. And I will give you one notable exception to that rule, if you will, today, or one notable exception to that situation in just a minute. But right here we have Amazon. And Amazon closed with a configuration, candlestick configuration known as a hammer. And that hammer, it's a little inconclusive at this point. If we would have closed higher, I would have said that Amazon is going to go much higher tomorrow. But given the candle configuration of the big green candle yesterday and now the hammer configuration today, it's actually a bearish hammer. We could have some consolidation tomorrow or some lower prices. I'm not exactly sure how to read that. And it is, as I say, a little inconclusive, and it does need tomorrow's trading in order to bear out so that it can be definitively looked at and determined if we are going to potentially go higher here, or if yesterday was an anomaly and we're just going to begin going to the downside again in Amazon. I don't know. We'll have to wait until tomorrow's trade. Now, I do think that the way the market closed today left so many things, so many questions unanswered, that in and of itself, that presents a level of uncertainty that the markets are not real happy with. So I think we could have a bias to the downside tomorrow just by virtue of the uncertainty associated with the close today. But we'll see. That's just my own thesis and my own look and take on the market. So the last stock I want to look at today is Facebook. And as you recall, yesterday, Facebook had just a amazing collapse, which got bought. And I mentioned bargain hunters had stepped in and kind of scraped up shares when it hit, this low. Well, there were a lot of interviews today on CNBC with analysts and fund managers and a variety of people, most of whom were of that thinking that Facebook had gone way too far. The market had overreacted. That yes, in fact, this this issue that's associated with the data firm is a serious one, but Facebook needs to be given kind of the benefit of the doubt, so to speak. And you can see how price actually made it up over the 200-day simple moving average today. But then it pulled back as the market pulled back into the close. However, the fact that price did move above the 200-day simple moving average is a good sign. It's a sign, it's an initial sign of healing, if you will, of price trying to reestablish itself. Now, we do have a candle configuration here known as a bullish engulfing. And if this was a red candle, it wouldn't be so impressive as it is, given the fact that this is a green candle. But if this were a technical only approach to making a trade in Facebook, I would say this is a screaming buy. But the news cycle in Facebook right now is extremely touchy. So let's take a real quick look at the 15-minute chart and see where Facebook is actually trading here in the extended session. And we've got about 2 minutes left before, so it's actually going sideways. Then that's a good sign for Facebook. When I say a good sign, I mean it's a sign that where the stock closed, which was right here, is basically being honored. We have a price level that is, it dipped a little bit and then it came back up again, and now it's down just a skosh, but it moved up off its lows and it's very close to where it closed the day. So if this continues overnight and we don't end up with some surprise announcement that implicates Facebook in something else, even deeper and more treacherous than what we already know they're involved in or have been unwittingly, potentially unwittingly involved in, we'll see. But the key here is that Mark Zuckerberg came out today and posted something on Facebook, basically being contrite, giving Facebook users the ability to do some things to help themselves as it relates to guarding and securing their own data. And that was exactly what the market needed. And it's what should have happened probably yesterday. But suffice it to say, it's done. And even though it's not really being viewed as a uh, a genuine gesture on the part of the Facebook CEO to address this, there are those naysayers out there that are basically saying, oh, he's just, trying to keep, the stock price from collapsing. Well, yeah, that's true. But I think there is a component of what he's attempting to accomplish that is in keeping with trying to, keep Facebook alive as well. You know, this is a huge deal, and he doesn't want this to happen again. And there's a lot of people who don't want it to happen again. And honestly, I'm one of them. As much as I think that what happened was horrific, and it's really a shame that there weren't more security protocols in place to forestall something from like this from happening. I mean, I use the Facebook platform, and I want it to work in a way that benefits everybody who likes my videos, who I can convene with in the social media platform of Facebook, for my personal use. I mean, my family's on there. So at any rate, I mean, that's a little far afield in the great scheme of things from what, this is all about. But, you know, suffice it to say that I do look at what's happening here as steps toward getting Facebook back on track to, give themselves an appropriate market share going forward. So we'll see what happens. So let me move this back to the daily chart, and excuse me. And that's about the last chart I really want to show. Well, you know what? Because we've been showing it so often lately, let's just go ahead and throw a chart of the VIX up there. All right. So today, I mean, volatility was up and down and all around today, but this candle here really doesn't give you much of an inside look at really what was happening as it relates to volatility. I mean, I'm in a volatility ETF, an exchange traded fund. The ticker symbol is the VXX. In fact, let me show you the VXX. That's probably the best way to kind of give you a view of what I'm doing. So let's get that in there. There it is. So the VXX is very interesting. And as you can see, coming into February, you can see that the VXX basically was on a decline. It was trading around $25 a share. Well, February came and we had that huge pop to the upside, and the VXX more than doubled. Now it's been coming down and having, little fits and starts in accordance with how the market's been trading. And we had that little move up the other day, which is when I bought puts, which basically is a trade designed to benefit from the down move in the VXX. Well, you can see how the VXX has moved down, but then it's kind of skirted back up again. So I am looking for the VXX to continue down over, a period of days, weeks, whatever, and we'll see if that happens. The trade is already up approximately just under $100. I mean, it's not a big trade, but volatility is a very interesting instrument to associate with your portfolio. You do need to be extremely cautious because volatility is, well, volatile. And back on February 5th, when the market exploded lower, volatility exploded higher. And when that happened, there was a volatility derivative instrument, an exchange traded note. The ticker symbol was the XIV, and it collapsed. It became virtually worthless. And there were a lot of people who lost a lot of money in that instrument as a result of the market just wham, getting traded hard and fast from a volatility perspective to the upside. Of course, that means that the market tanked to the downside. So when trading volatility instruments, you do have to be cautious. You do have to have defined risk trades, and you do need to manage them. So for now, this trade is acting very well, and I have my risk is defined, and I'm very pleased with the way that it's working. I've been in the trade just about 2 days, and I'm looking. Ultimately, I'm looking for about a $500 profit in this trade, and I'm not sure if I'm going to add contracts. I'm in the options yet or not, but that remains to be seen. The one thing I am looking at here is the way this is setting up. You can see um, we have a wedge here, and you're familiar with wedges now because I've been drawing them in the Dow Jones, but this is now keeping within the wedge. Now I want this to break to the downside, which means the markets will go higher. And that is the path of least resistance for volatility instruments, is to express whatever direction they ultimately move in that is in alignment with a market volatility that's going down, which means markets are going up. The S&P and the Dow and the NASDAQ and the Russell are all going higher, which means stocks are going higher. So it becomes a little confusing when you talk about volatility versus the market. But suffice it to say, at this point, the trade's working out, the market's working for me, and I am looking for ultimately this trade to pay me nicely based on the market moving higher, which I think the market ultimately wants to do. And now that it has an understanding of what the Fed is doing and why it's doing it, and even though there were some surprises today from the Fed, it still feels as if this market might have been able to digest that information without going through a reaction that was too over the top. But that's what I'm going to wait for tomorrow's trade. Again, this is the uncertainty dynamic I've been talking about. The market closed with more questions than answers today, so we have to wait till tomorrow to take a look at price action, how the market moves, and make the determination about how we proceed and participate if we choose to do so based on the market action tomorrow. So I did invoke the Dow Jones Industrial Average. So let's take a peek at that really quick, because that was the chart that I showed you that had the harami, if you recall. The harami was where the candle, the bullish harami, a green candle that was smaller than the body of the previous day's candle, but was held within the context of that candle. And so I told you that it needed confirmation. If we'd closed in the green, which it looked like we had a chance of doing, it would have been confirmation to the upside. But ironically, today we now have, and this is a very difficult, I need to take a little bit closer look at, and this is, okay, so this is actually a, well, it's not a true bearish harami, but it's actually a hammer, a bearish hammer, but it's also a well, and I'm not even going to call it a harami because candlestick purists will argue with me because of this wick, because the entirety of the candle is not contained within the body of the candlestick. It's not a true harami. I look at the thick part of the candle and see if it is held within. So for me, it's a pseudo harami, but in the great scheme of things, it's a hammer, and it's a bearish hammer, which tells me this market has a downside bias associated with it. So we'll see. We'll see what happens tomorrow, as always. And until then, I will wish you a good night and good trading.